Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Ted Dixon, CEO and co-founder of InkResearch.ca. He invented the Inc. Canadian Insider Index, which is used by the Horizons Canadian Insider Index ETF, a 2017 and 2018 Fund Data Fund Grade A Plus Award winner. His website, CanadianInsider.com. Welcome back to the show, Ted.
Well, thanks for having me back, Jim.
Ted, governments all over throwing all kinds of programs out there to help businesses. Are they throwing this money around prematurely? Should they wait to see how this is shaking out? Or is it more important just to get it out the door and then worry about how efficient it was?
Well, first of all, I think that the number one role of government is the public health side of things, and that's really where they needed to act appropriately and as quickly as possible. And unfortunately, I don't think in North America at the federal level that happened in either Canada or the United States. So now we're paying the economic price in both countries. And I just want to underscore the federal role in both of those countries as opposed to the local provincial health roles. I think they're completely different, and we could get into that, but from an investor's perspective, the mistakes made both by Ottawa, primarily at the borders, and in the United States in just being, I think, a little bit complacent about the risks involved. Now we're all paying the price in terms of these government bailouts, or support mechanisms, whatever you want to call them. So they are going to have to be massive. And what we've done at Inc. We've put a very basic framework together, Jim, looking at the potential outcomes of government action on these support measures, and we've categorized the outcomes as either being the D economy or the G economy. Okay, so the D economy basically is where governments kind of go by the 2008 playbook and they bail out a few businesses, and they give financial institutions some money, and they basically make the wealthy wealthier. Okay, I mean that was a trickle down playbook that the U.S. pioneered in the financial crisis, and to some extent we followed it in Canada a little differently, where we bailed out the automakers and the housing market. So those groups did fairly well. Not so much, people who were not riding those waves. In the U.S., it's a similar situation, but where Wall Street really made out very well in the 2008 playbook. But if they go by the same playbook, where the most of the money is channeled through the financial sectors, you're going to end up with, we think, a D economy, which really means is disinflation or deflation. Where all the money goes into asset prices. You'll continue to have this divergence between the wealthy and Main Street. Okay, but I think politicians have caught on that maybe they have to do something differently this time. And as we speak, Jim, and as we're recording this, I believe there's horse trading going on in the U.S. Senate right now over the support bill that Bernie Sanders wants more money for the unemployed, and he's taking, he's using the corporate support bailouts as part of the, leverage, saying, well, you're giving all this money to corporations, let's give more money to the people. So that's how it's, will be framed in the media, I think. So that's interesting. So we're moving. If we move away from the 2008 playbook, and look, I'm not saying what's right or what's wrong. I mean, it's like, as I mentioned at the beginning, it would have been nice had both governments in the federal levels been on top of this a bit earlier. That's what we pay them for. I pay Justin Trudeau to manage our borders, and if there's a threat at our border, for example, and I'm kind of diverging here, but I think this is important for after the fact, Jim. We do, just because there's a national crisis doesn't mean we don't hold our political leaders to account. And you think about it, if there was if the U.S. had been invaded by an enemy, and they had to use Washington State as a beachhead, and we knew that there was this enemy in Washington State, would we just ignore our border and say, well, don't worry about it? Which is really what Ottawa's attitude was. They were focused on China, which was appropriate. There was a problem coming from China, and they did a good job containing the virus from China.
But
they
BC
ignored,
was calling calls to close the Washington State border for a long time before Ottawa acted on it. Yes. Because Washington State was the epicenter of the U.S. Outbreak.
Well, it was, and and they didn't even have to close the border. They just needed to take firmer action to control and to quarantine people coming from Washington, but they did it way too late. And it wasn't just Washington; it was Iran and it was Europe. So they really took their eye off the ball, and I think that's something that Justin Trudeau needs to be held to account for down the road. In the meantime, we're getting these bailouts, and in the United States, if we get these, particularly because they're the biggest economy and they've got the most firepower in terms of being the reserve currency and being able to go big, if we get a big response, that sort of the Bernie Sanders type response that puts money in the pockets of people, then you basically got what we call the G economy. Okay, so if you go by the 2008 playbook, where you focus on the trickle down and bailing out banks and corporations, we think we're going to get the D economy, where you're going to get a concentrated benefits, and you're going to enrich a few, but they're not going to spend a lot of money. They're just going to get richer, and what everyone else kind of suffers, and that's going to lead to a kind of depressing a D economy. But if you get a G economy, it's not necessarily that much better, but it's different. G doesn't really stand for growth; it stands for government-led. Okay, so that's not exactly the kind of nirvana outcome that I'd like to see, but I think those are the two choices we get. And under the G economy, though, you're probably going to get more inflation than you would under the D economy, just because you're giving people more money, you're spending more money, and you're going to have more money floating around the economy, actually going after goods and services. You see, Jim, when you just bail out the rich and the wealthy, they don't necessarily spend it on goods and services. They'll go buy another house or or a yacht, or so you'll or more paintings. So yeah, there'll be inflation in those types of assets, but you don't get the kind of inflation that resource companies need, for example, like buying more gadgets that require metal, buying more services that then people go out and drive their cars more, to go around and get them. So if you get this G economy, you'll likely get more inflation. Now, look, this doesn't mean we're going to get hyperinflation. This doesn't mean we're even going to get double-digit inflation, or we may not even get 5% inflation. We may not even get 2% inflation, but we'll get more inflation than we would if we go with the D economy. So that's why for investors watching, that's why there's so much hanging on this vote in the U.S. Senate coming up. It's just, it will mark what kind of path we go down, we believe, whether we go down the D economy path or the G economy path. But ultimately, the other key element to all this is how quickly do we get on top of the public health costs associated with this in terms of lives and in terms of economic activity slow down by having to do these shutdowns and self-isolations, social, and basically it's the shutdowns and the quarantines that are the big issue here in terms of the economy. How long do those have to last? And on that, we're looking at some really important metrics, I think, that the market's going to key on, and that's going to be important, I think, for your, every listener to keep on top of. And what we do at Inc., we're looking at that in relation to our insider sentiment and looking at how insiders are reacting to the news flow and what they're telling us about where we are in the cycle. So from that perspective, we're seeing some early signs that maybe we're near the end of, or the worst of at least the first wave here. But we're still early days in trying to maybe assess that we've got a durable support level for stocks.
We'll have more with Ted Dixon right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Ted Dixon. Ted, is it important for governments to get help into the hands of individuals who've lost jobs or are at the verge of losing jobs, and also for small businesses who provide over 70% of the jobs in both Canada and the U.S.?
Absolutely, unless you want to go down that de-economy path that we were talking about. Unfortunately, there's no good outcome here in terms of free markets. There's just we believe the D economy or the G economy, if you do get more cash into the hands of the working people, and I mean working people, I mean sort of middle class down, anybody who's, basically living, paycheck to paycheck, mortgage payment to mortgage payment, those are the people that need the direct help, not the financial crisis playbook where you basically plastered Wall Street and the mortgage markets with money in Canada, and Wall Street they did both. So in the United States they did both. So helping out and small business is also important. Otherwise, you just get big businesses being even more powerful on the other side of this crisis, and that has big implications in terms of productivity and fairness in society, and just in innovation down the road. It's really important that we don't emerge from this, a big government and a big business economy. That would just be that's not the kind of society I certainly want my kids to grow up in, where you've just you've got corporatism at the government and the business level. So from that perspective, in terms of the bad choices that we have here, it's good to see that policymakers are recognizing that they're getting money into the hands of the people. Now, let's talk about what that means for markets and stocks. Okay, so importantly, the United States, they look like they're at least not going to be doing the same 2008 complete playbook. It looks like it's going to be at least half and half, new playbook, half old playbook, which is better than all old playbook. And what we're looking at, what we've noticed in the U.S. is the banking insiders are the most positive group of insiders in the U.S. And in fact, we sent out a report today to our subscribers called Bankers Buying as Bad News Booms. And we've seen peak insider buying already in the banking sector in the U.S. And that is pretty encouraging news. If you remember in 2008, it was a banking system that nearly brought the world down. Okay? Well, that's not the case this time. And if there was some problems, the Fed has come in with their Fed aid again, and you put some pretty strong crutches, I think, under the financial system. But more importantly, let's bring it back, Jim, to your very question. Sending checks to people in small businesses. Well, that also helps the banks, because that allows their customers to keep solvent and keep going, and it means a little bit less stress on the banks, at the grassroots level. Okay, so that's a positive for the banks, and it also, if by spending big, it should at least keep longer-term interest rates higher than they otherwise would have been, and that's positive for the banks, at least on a relative basis in the United States. They need higher long-term interest rates, so anything that the government does that keeps those higher rates from collapsing, like they did in the financial crisis and like they did in Europe, is a positive for the banks. So we've seen peak insider buying from the banks. We think that Monday was a huge support level for bank stocks in the United States. So now that could give away by the time, by tomorrow, basically by the end of the week. This market is so volatile right now that support levels can be broken at any time. But as far as our signals go, when we see peak insider buying like that, it's usually a positive sign so the U.S. banks are looking good. That doesn't mean the whole U.S. market is looking good. I just think if you're looking for leadership, let's keep your eye on the bank. For example, you can look at there's a banking ETF. I believe it is called the. What is it called here? There's a couple of them, and I'm not recommending this ETF. It's just something that we watch, but it's the S&P. Here we are, the Spider KBW Bank ETF. So let's watch that and see how that's doing over the next week or so. If that can outperform the market, then that's a good sign. But look, we're not out of the woods yet. We haven't seen peak insider buying in the United States. That means, we're not confident that the lows have been set for the broad U.S. market. Let's hope they have been, but we're just not confident that they have been. So that's something to keep a watch on for peak insider buying in the United States.
We'll have more with Ted Dixon right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ted Dixon. Ted, both Canada and the U.S. are consumer-driven economies. Canada a little less so because we export a lot of things, but still, if the consumer is kept up and running through all this, will that speed up our recovery?
Well, it'll sure help mitigate the damage, and so it would be a positive for certainly consumer-oriented stocks in Canada, and again the banking sector. So it would help in terms of working through this. Whether it would speed it up or not, I think that's a bit of a different question. And even that, in these difficult times, I think there's a difference between speed and damage. You could, I think, I've seen some studies, indicate that if you just let this virus run its course, we could be done with this crisis much faster. Unfortunately, the cost would be much higher. You'd have put a lot more stress on our hospital systems. And in fact, in New York State, there's a real risk right now that they haven't got on top of it early enough, and that you are going to see some pretty ugly headlines, before we do this show again in 2 weeks. I hope that's not the case. But if you don't get on it, fast enough, if you don't take these mitigating actions, you can get very, very quick results, unfortunately, but they're not the results you necessarily want to see. So in Canada, we are more globally oriented. And what's interesting, too, is that if the Canadian public health officials are able to see a peak, if they've acted fast enough where we see a peak in these cases, new cases very soon, and this is what we're watching, and in our market report on Monday, we sent out a link to a University of Toronto website that's tracking the cases in Canada. And if we see a peak, we'd hoped we'd seen a peak last week. That hasn't turned out to be the case. Hopefully it will be Wednesday. Hopefully we've seen a peak in the growth rate. In British Columbia, there's tentative signs that we've seen, a turn, that the growth rate in these cases is dropping. That could change, but that's tentatively what we've seen. Well, that will be good for the consumer sector and Canadian stocks, domestic stocks. If the Canadian consumer is in better health shape, right, than the U.S. consumer. And you're going to see some pretty brutal U.S. headlines over the next 2 weeks, which I hope I'm wrong about. It looks like there's something coming. But in general, we're very close, Jim, to seeing a peak in Canadian insider buying. We haven't quite been able to confirm that yet. Our indicators, our Inc. indicators, which track insider sentiment, which is based off of insider buying, they are a bit lagging or, coincidence, so they can lag a couple of days usually. We look like we're close to it. Monday may have been a key support level, but it's too early for us to say at this point that that's where we're at. But it would certainly be nice if it were. And it would be nice for two reasons. For investors, one, it would indicate we have a major support level in stocks. So, one has to, of course, put a lot of uncertainty around that. So I don't think at this point now is the time to go all in. But I think if you've got a major support level, you can start looking for some bargains out there and maybe, contemplate going in a little bit, right? And spreading it over time, seeing how things evolve. But, and everyone's got to look at their own risk tolerance and their time frame. So that's not advice. That's just saying, depending on your circumstance and your risk tolerance, if we do have a signal that there's a floor, well then, you don't also want to miss out if that is the floor, but there's no guarantee that's the floor. So it's trickier than usual. It's always a tricky time to try and identify a floor and or a support level in stocks, and now it's even worse. So, but we haven't got the peak yet, so we can't even make that call. But it looks like we're pretty close to it. But we'll be updating our subscribers on that when we get it. The other aspect of it is when we do see a major peak like this, and this is going back to our experience in the financial crisis. I lived through that, and we saw our indicators work during that. When we see a peak in our Canadian insider buying sentiment indicators, it was good. It did coincide with a floor in the junior stocks and also in the really globally sensitive emerging market stocks, the stocks that were hit the hardest, beat up the hardest. So, if we see this Canadian indicator peak in terms of insider buying, it should coincide hopefully with not only a floor level in the Canadian Insider Index, which has been hit very hard here, being mid-cap oriented index and has resource stocks in it, but it would also perhaps suggest that volatility is going to start to head down, and that would also be an important consideration for not only everyday investors, but if you got financial advisors who are listening out there. The psychology of your clients and investors changes once volatility starts to subside. The panic isn't as much. You shouldn't be getting as many phone calls saying, "Get me out, get me out." That usually happens around peak volatility. So let's see where the indicator goes over the next few days. As we're very close. Our 30-day indicator is over 400%. That's the highest we've seen it since the financial crisis. That means there's been more than 4 stocks with key insider buying for everyone was selling over the past month. So we need to see our 60-day validate that, and we're not quite there yet, as I said. But we seem to be getting pretty close, and we may have already seen the major support level put in on Monday, but we won't know that at least for a couple of days.
Ted, what about junior mining stocks? Have they been hit hard, and are they providing opportunities, especially for gold miners?
Yeah, they've been hit massively hard, like everything else. I think a lot of the problem a lot of the concerns about investors was, how will COVID-19 affect exploration, right? And we've seen, and it really depends jurisdiction by jurisdiction. We see, I believe in Quebec, they've stopped exploration for the most part, but in other jurisdictions, I don't believe they have necessarily. Okay, but that could all change. So even though you've got, you think what what you're dealing with in day, week 1, week 2, the rules change. So that's why investors have taken money off the table. But we did send out a report today on Wednesday to our clients focusing on the junior mining sector. We have seen a fair amount of insider buying. So insiders are starting to certainly pick up what they seem to indicate are bargains. But, it's only for those. The junior mining sector, I would say, would flourish the best under that G economy scenario we talked about earlier, where you've got government coming in and boosting the inflation prospects, where you're putting putting money in the hands of the people who will spend it on stuff as opposed to spending it on art and, big mansions, right? You want the little guy out and little gal out buying stuff, going, back to the department stores or their local store to buy furniture, like gadgets, right? I mean, and I don't mean iPhones, I mean stuff, right? Stuff that people need. So that's the difference between the G economy and the D economy. Junior mining, or precious metals, depending on your risk tolerance, those are a group that would benefit, we believe, from the G economy. We've seen a lot of bargains. We've seen a lot of insider buying. You can follow it on CanadianInsider.com. You can, if you want to join the Canadian Insider Club, you'll get our newsletter every trading day. And we don't always talk about junior mining, but today we did, and there was some interesting buying going on there. So yes, if you believe in the G economy, that's where we're headed. You certainly want to consider exposure to sort of hard asset stocks and hard assets as well. But if you're uncertain, if you think we're going to the D economy, it's a different ball game, and that's just look back to 2008, what happened, and the struggles that the junior mining sector went through after that first round of QE. There was a nice little bump when everybody got excited when Bernanke did the first round of QE, but when he kept going and it became clear that it was really a bailout for the wealthy, then junior mining ended up in a massive bear market. And I would expect the same to happen again if we go into the D economy. But it's not just going to be junior mining that goes into a bear market under that situation. So the junior miners would have plenty of company. But look, the early indications are we're heading, I think, towards attempts to move towards the G economy, and we'll just have to see how things shape up. And we'll get our first indication, I think, probably over the next 24 hours out of Washington. We'll see what's in the final package, and we'll see how much money they're going to start spreading around to their average citizens as opposed to what they did in 2008, where the money, basically was a gift to Wall Street.
Ted, thank you so much for chatting with us.
Well, thanks for having me back, Jim.
My guest has been Ted Dixon, CEO and co-founder of IncResearch.ca, Canada's first online financial news and research service providing insider news and knowledge to investors. His website, CanadianInsider.com. If you have any questions for Ted or any of our other guests, you can send them to info@HowStreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.